Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at Mastercard Incorporated, ticker MA. It's come across my radar in the past. I knew that it was a good company, but I wanted to dig into it and see what's going on here. And right off the bat, one thing I noticed is from 2020 up through 2023, this thing was just trading sideways. This is one of the flattest charts that I have seen. There was a bit of a dip back in 2020, like everything else saw, but it came right back up and has been trading sideways since. If you continue on right now, as of late 2023, it's finally broken out of that sideways trading that we had seen, and it's pushing up to new highs. 440.94, the highest that we've seen on the stock, and that was pretty recently, late January, January 22nd. Which was 5 days ago. So approximately a week ago, it hit new all-time highs. So if it's incredibly overvalued and potentially not pushing farther upwards, I'd be looking to trade it and potentially invest with other people's money. And that is what I'm entertaining here. So when we go to the dashboard, our little summary for the stock, we see it's currently trading at 438, 449.4 was the high. The low was 340.21. What we're coming up with for our fair value would be 319. It'd be overvalued at 353, and it'd be undervalued. We'd really want to buy in around 270, which looks like it's not going to happen. The lowest that it's been is still a little inflated, so we do want to work in a bit of a premium here. Currently, we're looking at 5% premium because it is a very good company. If we up this to 10, we could get the low being a more reasonable price. This doesn't look like it's something that you can really get for a very cheap value price. It's something where you're paying for that value of the actual company. Discounted cash flows are coming up with 407, so that is something. The cash flows are very strong here. Cash flow yields in the 40s. Their margins are incredibly strong. Earnings yield is a little low, so they don't have a lot of earnings, but they have quite a bit of cash flow. Well, they do have a lot of earnings, just not for the price that it trades at. Dividend is almost nothing, not a large payout ratio. Doesn't seem to be something big they focus on. Returns are amazing across the board. ROE is inflated by that debt to equity. I mean, it's a financial company, so there are things in there that are going to be done a little different. So we can kind of give less weighting to that balance sheet and that debt because it could just be a transaction that they're waiting to settle and such. Historical growth, nearly 10% over the last 3 years, double digits over the last 2, analyst projections of 12% over the next year. So we're going to plug that into our thesis if they can continue with that 12. Earnings per share, double digits. It's looking like it's going to drop down to single digits, but that's still a really good number, 8.55%. Cash flows, they've grown it faster more recently. It's something that they're very strong on, so we'd hope that the cash flows would grow in line with the revenues, maybe slightly lagging. So we are going to go with that. Share count, they are buying back shares. Looks like they're speeding it up. If it's just a single dollar value every single year, of course, that'd be a larger percentage every year. So we are going with share count. They're going to buy back more like 1.7% of the existing shares per year. These are averages over the next 3 to 5 years. Assets picked up on growing it more recently. We're going to go with that 5%. Liabilities also picking up. We're going to go with 7 there because that's what they recently came in with. And then dividend growth, we can actually raise this. 9 and 12 are what we're seeing. So maybe we can just go with 10, do more of a midpoint here and see what that gives us. So with this being our thesis, we'd be looking at, in 3 years, the fair value of the stock being 346. And so you'd be looking at, if you buy at today's price, you'd be looking at a pretty big loss of 19% because the growth is just not there over the next 3 years to make up for the current share price. Now, it's currently trading at 5-year values, which is a huge premium. It's always been trading at a pretty far out premium. I mean, these PEs 54, 41, 34, 36. So it trades at 30s, so twice what the market typically sees. Meaning, if that valuation holds with the market, you could see higher returns than this. This would be a more traditional, I'd say, if it were your standard company, you'd be looking at essentially breaking even over the course of the next 5 years, buying at today's elevated price. Now, those returns, though, you'd be looking at 12.32% returns every single year for the next 3 to 5 years. The only issue is how overvalued it is at the moment. It's a stock that I would keep on my radar, but I would not be investing too heavy into it, right? So this is just a quick video, essentially saying it's at really elevated prices right now. 410 might be a little reasonable with the discounted cash flows. It's very strong on cash flows. So you could invest heavier with that metric in mind. Personally, I'd really like to see it around 340, 350 again, and that's where I would be investing. But I would not go too heavy into it at today's valuations because it traded flat for the course of the last 3 years. And I understand why, because the valuation was just so high. It's quality, but it's not growing at the rate to drive that share price any further. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.